Our next guest doesn't think we're in a recession right now. He doesn't think one is priced in, but investors should brace for more market downside ahead. Let's welcome back Dan Suzuki, the Deputy Chief Investment Officer at Richard Bernstein Advisors. You're in good company today, Dan. We've got a lot of people who think that there's a lot more downside to the markets here. What's your sort of reasoning behind this, and why is it not possible that perhaps the markets are so forward-looking that we are pricing in that period of time that is beyond the impacts of the full Fed tightening, that we are pricing in the period beyond this inflationary period?
Yeah, I mean, first of all, hey, Melissa, and the whole conversation, I can't agree more with pretty much everybody's comments so far. I think everybody's spot on. This debate about whether we're in a recession or not is just kind of silly, right? I think, what people are mistaking for a recession is a broad-based slowdown. Now, there's no doubt in my mind that pretty much every significant part of the economy is slowing right now. And if this continues down this pace, we will eventually be in a recession. But to say that we're in a recession right now, where huge components of the economy, namely the labor market, are incredibly still strong, yet slowing, but strong, it kind of misses the point. And in terms of being priced in, certainly, the markets have priced in. I think what's more been priced in is the tightening of liquidity, the inflation story, and the Fed, and less so the slowdown in growth, although some of that has been priced in. But the reality is, what recession have we ever seen in history where, with the Fed ultimately, cut 50, 60, 70 basis points? That's basically what's priced in. And I don't think that's a real logical, estimate of what cuts are really going to look like if we're in a recession. So I don't think the bond market's pricing in. I don't think the stock market's pricing in either.
And Dan, after a 16 or 17% off those lows rally in the NASDAQ, mega cap tech stocks aren't pricing it in. What have you heard in this earnings season? I just talked about, I haven't heard, and I know you're saying there's two certainties, Fed will hike and EPS will go lower. Earnings are not going to go higher in this environment. What did you hear in this earnings season in terms of the cadence of this market move? We're all trying to kind of time it. We all believe that some of these conditions haven't really been felt yet. I'm just curious what you heard.
I mean, Tim, I heard the same things you heard, which is basically things have slowed, but not as much as feared. And I think that's true with every part of the economy, including, the earnings we got from the big tech companies. I think that's right. I mean, the market braced for some really, really horrible earnings. I think it was, the topic of every research report for a good 3 weeks going into earnings season was just how bad it was going to be. It wasn't a great earnings season, but people were braced for the worst. I think people have that mentality with regards to a lot of the economic data as well. My issue is not with this earnings season, but I think we're on the wrong side of the profit cycle. So in this part where things are slowing, it's not just this earnings season where, again, people were braced for that. It's the next earnings season, the earnings season after that. And then typically, you're going to see, especially as earnings go negative for a lot of these companies, you're going to see, a lot more layoffs, a lot more job cuts, a lot more write-downs. And that dynamic is going to spiral. And I think that's what's going to catch people off.
You're going full defensive, Dan. Healthcare, staples, utilities, but stay on the sidelines is your bottom line message. Does cash figure into this, given your market outlook?
Yeah, on the fixed income side of our portfolio, I mean, we're kind of a barbell between cash and cash-like, short duration, floating rate stuff, and then ultra long, high quality Treasury exposure. I think right now it's a good time to own a good amount of cash, but it's a good time to own duration as well. I mean, we've been pounding the table that you don't want to own duration, but if the next leg of this cycle is really going to be about the growth slowdown and less the liquidity story, I think duration makes a lot of sense here.
Dan, good to speak with you. Thanks.
Thanks, guys.
Dan Suzuki. Brian Kelly, last time we talked, I think you said your top drawer was empty, meaning your long-term investments. Is it still empty? I am assuming it is.
Yeah, I've got nothing in my drawers. Nothing whatsoever. No, I mean, listen, I bought some bonds today. I think that's probably a decent play for the short term. We've had 20 to 30 years of a bond market that's manipulated, and now finally you can kind of listen to the message of the bond market. So going to what Dan said, if you're looking at yields going lower, that is a sign that the economy is weakening. So if I had to buy like one thing, maybe it's TLT or something like that. I think that's probably the place to be.